That nagging feeling, right? Like your hard-earned money just, well, it isn't stretching as far as it used to. You're
Hmm.
definitely not alone. Today, we're diving deep into inflation, that invisible force that's kind of quietly eroding your purchasing power.
Yeah, it creeps up on you.
We'll look at what it actually means for your personal finances and maybe more importantly, what you can actually do to sort of push back.
Exactly. And for this exploration, we've pulled together a really useful mix of information. Think
No.
practical financial advice from expert articles,
Right.
the unfiltered reality of budgeting with rising costs from a really fascinating Reddit thread,
Oh, interesting.
and then the official numbers on UK inflation, just to give us the broader picture. Yeah.
Okay, good
Yeah.
mix. So, our mission today is pretty straightforward. Cut through the complexity and arm you, our listener, with some clear insights and hopefully actionable strategies to
Mm-hmm.
navigate this whole inflation thing without feeling totally overwhelmed. Okay,
Sounds like a plan.
right, let's get straight to it then. What exactly is inflation, just in simple terms?
Okay, so at its heart, inflation is basically the rate at which the prices of everyday things go up over time. Simple as that, really.
Okay.
And when that happens, well, the same amount of money buys you less than it did before.
Right, like things getting more expensive.
Exactly. A really basic way to picture it is with something like a pint of milk. If it costs £1 today,
Yep.
and say there's 10% inflation, well, that same pint will likely set you back about £1.10 next year.
Got it. Okay, so it's not just some abstract economic theory, is it? This has been happening for a while.
Oh, absolutely. One of our sources actually reminds us that back in December 2017, the UK inflation rate was already at 3.1%.
Right, okay.
So even then, if your money was just, sitting in a standard savings account, it was slowly but surely losing its value.
Losing purchasing power.
Precisely.
Yeah.
And the sheer scale of this is, well, it's quite eye-opening. One of the articles we looked at estimates there's something like 60 billion.
Yeah.
Yeah, 60 billion pounds. Sitting in long-term low-interest cash savings across the UK.
Okay.
And because of inflation, this huge amount is losing around 1.5 billion in real value every single year.
1.5 billion. Just evaporating.
In terms of what it can die, yeah. It's a significant drain. So you might see a slightly bigger number in your account
Yeah.
from a tiny bit of interest,
Right, like a few quid.
but you're actually getting poorer in real terms. It's like running up a downward escalator. You have to move faster just to stay put.
That really hits home. And it's not just about savings, is it? I mean, if inflation is running at, say, 3% or higher, like one of our articles pointed out, even your monthly paycheck starts to buy fewer and fewer goods each month.
That's it. It's like getting a little bit less for your work without actually seeing a pay cut on your slip.
Yeah, sneaky.
Precisely. Now, what's really interesting, and something that came up strongly, is the gap between the official inflation figures we hear about, like the CPI,
Consumer price index, yeah.
and what people are actually experiencing day to day. That Reddit thread we mentioned really brings this to life.
How so?
Well, people are sharing stories of, significant increases in the cost of essentials. Things like food, energy bills, car
The
insurance.
stuff you have to buy.
Exactly. And often way beyond what those official CPI numbers might suggest.
And we did see the latest official figures, too, didn't we? CPI fell to, 2.6% in the year to March 2025?
That's right. And the RPI, the Retail Price Index, which includes housing costs, was a bit higher at 3.2% for the same period.
But as you said, that Reddit thread highlights that these averages, well, they don't tell the full story for everyone's individual situation.
That's such a crucial point.
Mm.
As one Reddit user put it so well, inflation is very personal.
Yeah, I like that.
For many households, the prices of the things they really rely on have shot up much more dramatically. We saw users saying their food bills were up by 50%.
50%.
Yeah. And car insurance costs jumping by like 34%. This difference can create a real disconnect, between the headlines and what you're actually feeling in your wallet.
Definitely.
And that feeling of your own personal inflation rate being much higher. Well, many people felt that intensely during the peak we saw recently.
Oh, yes, the peak. That was pretty high, wasn't it?
It was. Our sources remind us the UK hit a peak inflation rate of 11.1% back in October 2022. That was a 41-year high.
Wow. Yeah, that really underscores the financial pressure people have been under.
Absolutely.
Okay, so it's a stark reminder. And when inflation is higher than the interest you're earning on savings,
Yeah.
you mentioned this downward escalator thing.
Mm.
you end up with negative real returns.
Exactly. That's the technical term.
Hmm.
So even if your savings pot technically grows a little bit on paper,
Right.
its actual buying power is shrinking.
Yeah.
And to add insult to injury, you often have to pay tax on any interest you do earn,
Oh, yeah, the tax man.
which just chips away further at the real value.
So it can feel like you're losing on two fronts.
It can feel like a tough situation, definitely. So the key becomes finding ways to make your money work harder than inflation. We'll get into strategies later, but this really highlights why just leaving cash in a low-interest account isn't, well, it's not a great long-term approach.
Okay. Now, you mentioned making money work harder. Is there such a thing as a truly inflation-proof investment, like some kind of financial superhero product?
A financial superhero. I like that.
Is there a fortress we can build?
Well, the truth is, finding truly inflation-proof investments yeah, it's a bit like searching for a unicorn. It's very difficult.
Okay, so no unicorns.
No unicorns, unfortunately. However, there are some options specifically designed to offer a degree of protection. Index-linked gilts, for instance.
Gilts, those are government bonds, right?
Exactly. Think of them as government IOUs. But with index-linked ones, the amount they pay back actually increases in line with inflation, usually based on the RPI measure.
Ah,
So if RPI inflation is, say, 3%, the return you get on these specific bonds should also roughly increase by 3%. The aim is to keep your investment's buying power sort of stable.
okay, so not exactly proofed, but linked to try and keep up.
Precisely. It's designed to offer some protection.
Right. Okay, so we've established inflation is real, it's personal, it's been happening, but how has it specifically hit our wages and what we can actually afford?
Yeah, this is where it gets really interesting and perhaps um, a, a little concerning for many people.
Okay.
Inflation's had a pretty significant impact on the UK job market. It's created this noticeable disconnect between the amount your payslip says you're earning, what economists call nominal wage growth,
Right, the number on the paper.
and the actual economic value of that money, what you can actually buy with your real purchasing power.
Can you give us a clear picture of that gap, like a real-world example?
Absolutely. Let's take someone earning, say, £35,000 back in 2022,
Okay.
because the Consumer Prices Index, including owner-occupiers' housing costs, that's CPIH,
Right, includes housing.
yeah, it increased by around 17% between January 2022 and October 2024. So that person earning $35K, well, they would have needed their salary to jump to roughly £41,000 by 2024,
Just to stand still.
just to maintain the exact same standard of living.
Wow, a 6,000-pound pay rise just to tread water. Did most people actually see their wages go up that much then?
Well, sadly not. The data shows average wage growth during that 2022-2024 period was hovering around maybe 5–6% each year.
Okay, so much less than 17% over the period.
Much less. Which means inflation was consistently outpacing wage growth, maybe by about 2–3 percentage points annually. This led to a real decline in wages.
Or decline.
Yeah, estimated somewhere in the region of 15–20% over those 2 years in terms of real buying power.
That's a really significant drop in what people can actually buy with their earnings. Ouch.
It is. And it's not just a temporary blip we're talking about either, is it?
Doesn't sound like it.
That's right. If you look at the longer-term picture, one of the sources, the Institute for Employment Studies, points out that a £35,000 salary back in 2010,
Okay, going back further.
yeah, back in 2010, that $35K had the same purchasing power as about £53,000 in 2024.
53,000.
Yep. All thanks to the cumulative effect of inflation over those years. However, the vast majority of jobs haven't seen salaries increase anywhere near that much in the same period.
So wages just haven't kept up over the long haul either.
For many, no. It really highlights how inflation has gradually, sometimes almost invisibly, eroded the real value of wages over time.
It's quite sobering to think about that long-term impact. Okay, so we have a good grasp of the problem. Money isn't buying as much. Wages haven't kept pace. Let's move on to solutions. What can we actually do on a personal finance level? What are some practical strategies?
Right, the practical stuff. Well, our sources offer a whole range of strategies, from the big picture investing side to everyday tweaks. Starting with investment, that Endeavor Financial Planning article really emphasizes the importance of investing in options, that have the potential to deliver returns above the rate of inflation.
Trying to beat it, essentially.
Trying to beat it, exactly.
And did they give specific examples of what those options might look like?
Yes, they did. They suggested considering broad tracker funds.
Okay, trackers.
Yeah, think of these as funds that automatically invest in a wide range of company shares, aiming to just mirror the performance of the overall stock market, maybe UK or overseas.
Right, spreads the risk a bit.
Exactly. They also highlight the tax advantages of ISA's individual savings accounts.
Ah, yes, ISAs, tax-free growth.
That's the key benefit. They're a way to save and invest without paying tax on the interest or profits. These ISAs can hold different things, monetary funds, shares, other investments.
Okay.
But they do caution, and this is important, that you really need good advice when choosing funds, as performance varies a lot.
Makes sense. Don't just jump in blindly.
Definitely not. And they also stress spreading your investment risk across different types of assets. Oh, and for the self-employed listening,
Yeah.
they specifically recommend seeking professional tax planning advice to make sure you're being as tax efficient as possible.
Good tip. Okay, so that's the investment side. Making money work harder, being smart about tax. What other proactive steps came up?
Well, from PensionBee and Aviva, we see some pretty consistent themes. One is actively looking for savings accounts that offer interest rates that actually beat inflation,
If you can find them.
if you can find them. That's the caveat, admittedly. It can be a challenge in the current climate.
Right.
Investing in the stock market, either through your pension or other products, is also mentioned again. It's seen as a way to potentially get higher returns over the long term.
Potential being the key word there.
Absolutely. Comes with risk. Always important to remember that. PensionBee actually points out that historically, global stock markets have grown, on average, around 10% per year over the last decade, which is significantly higher than the UK's average inflation of about 3% during that same time. So historically, it has outperformed.
So higher potential reward, but definitely need to be aware of the potential downsides, the volatility.
Exactly. They also suggest maybe considering shorter-term savings products if you think interest rates might rise soon, gives you more flexibility.
Right. Don't lock everything away for years.
Potentially, yeah. And pensions are strongly recommended, of course, for their long-term growth potential and those valuable tax relief benefits.
Yeah, the tax relief is a big plus.
Huge. Workplace pensions, especially if your employer contributes.
Free money?
Well, yeah, essentially. That's highlighted as a really smart first step. And SIPPs, self-invested personal pensions, are another option if you want more control over your pension investments. They also come with tax benefits.
Okay. And ISAs came up again?
Yes, stocks and shares ISAs specifically, again, as a tax-efficient way to invest. The annual limit for 2026 is £20,000, they mentioned.
20 grand tax-free investing potential. Okay. We also saw brief mentions of other assets, didn't we? Things that might act as a hedge.
Yeah, things like property and commodities, like gold, were touched upon. Some investors consider these as potential ways to protect against rising prices.
But with risks.
Definitely. They come with their own specific risks and aren't suitable for everyone. And, as we mentioned earlier, those index-linked gilts came up again as a more direct way to try and keep pace with RPI.
Right. Okay, so that covers some of the more traditional financial advice investing, saving smartly. But what about the everyday stuff? Budgeting, spending adjustments. That Reddit thread sounded full of practical ideas.
Oh, absolutely. That thread was fantastic for real-world coping mechanisms. A really common theme was just the need to regularly revisit and, manually adjust your budget.
Keep tweaking it?
Yeah, because costs are changing. There's also a strong awareness of the difference between genuine price rises from inflation
Right.
and what some users cleverly called lifestyle creep.
Ah, lifestyle creep. Explain that.
It's basically where our spending just tends to gradually increase over time, maybe on nicer things or more conveniences, without us necessarily realizing it's happening. It's not just inflation making things more expensive.
That's a really important distinction. Sometimes our spending goes up just because, well, we let it.
Exactly.
Yeah.
So being mindful of that. Then, when it comes to actually managing day-to-day spending, lots of users shared tips on adjusting habits right at the point of purchase.
Like in the supermarket.
Yeah, exactly. Things like choosing own brand or store brand products instead of the more expensive premium brands.
Dropping down a brand level.
Yeah. Being much more mindful of what's actually going in the trolley. Making a conscious effort to maybe eat out less frequently or get fewer takeaways.
Okay, makes sense.
Budgeting apps were also mentioned a lot, seen as essential tools for tracking income and outgoings, especially if you've got multiple accounts, credit cards.
Keeps it all in one place.
Yeah. Apps like Wyandotte were specifically recommended by some, but others pointed out there are plenty of good free alternatives too.
Good to know. And it wasn't just about cutting back, was it? Boosting income came up too.
That's right. Proactively looking for ways to increase your income was seen as a key strategy.
How?
Well, anything from asking for a pay rise in your current job.
Which might be tough given the wage discussion earlier.
Yeah, potentially. But also exploring side hustles, maybe bringing in extra income that way, or even considering a longer-term move like a career change if it offers higher earnings potential.
Thinking bigger picture.
Yeah. And the want versus need now versus later rule for spending also came up quite a bit.
Explain that one.
It's just a simple but effective way to pause before buying something and ask, is this really a need right now or is it a want? And if it's a want, can it wait until later?
The pause button. I know I've definitely fallen into the crap of a want feeling like a need after a long week.
We all have. It's just a good reminder to evaluate.
That's really practical. What other everyday tips did the Reddit community share?
Let's see. Having a bit of a cash buffer, to avoid expensive overdraft fees, that was highlighted.
Yeah, fine.
Also, the importance of regularly rebalancing your budget, identifying and cutting back on non-essential spending. Exploring the secondhand market came up too.
Like for clothes, furniture.
Exactly. And generally trying to buy fewer consumable goods. Several users also emphasized that ultimately focusing on growing your income.
Right, back to income.
Yeah, whether actively through work or passively through investments is probably the most effective long-term way to really get ahead of inflation, rather than only focusing on trimming expenses.
So it's both sides. Manage spending A&D, try to earn more.
Ideally, yes, and maybe obviously, but still important. Considering cheaper alternatives for pretty much any goods and services you regularly use. That was a common sense tip lots of people are doing.
Shop around, compare prices.
Basically, yes.
Okay. And what about managing existing debt in this environment? That's a big worry for many.
Crucial point. One source, Standard Life, specifically advises making it a priority to pay off outstanding debt, especially debt with variable interest rates.
Why variable rates?
Because those rates are likely to increase when inflation rises, which makes your repayments more expensive over time.
Okay. Get rid of those first, if you can.
That's the advice. They also recommend taking a fresh look at your overall financial goals, maybe adjusting them if needed because of the economy.
Be realistic.
Yeah. And conducting what they called a direct debit detox.
A detox. Sounds refreshing.
Yeah, but basically going through your bank statements and identifying and canceling any subscriptions or services you're just not really using anymore, gym memberships, streaming services.
The forgotten subscriptions.
Exactly. Freeing up cash. And again, really making the most of tax-efficient savings options like pensions and ISAs.
Okay.
Finally, they suggested prioritizing essential spending, maybe delaying non-essential purchases, but also, interestingly, considering making necessary big purchases sooner rather than later if you have the funds. Because prices for those big-ticket items, like cars or appliances, might continue to rise significantly. So buying now could save you money compared to waiting, if it's something you definitely need and can afford.
Right, a bit of a balancing act there. Okay, so a really comprehensive set of strategies, big investments down to daily spending habits and debt management. Now, let's zoom in specifically on pensions. How does inflation affect them? That's a big concern for future planning.
Absolutely. Okay, so for those currently receiving the state pension, inflation actually plays a direct role in how their payments increase each year. It's thanks to the triple lock policy.
The triple lock. We hear about that a lot. How does it work again?
It guarantees the state pension rises by whichever is the highest of three things: CPI inflation from the previous September, average earnings growth, or a baseline of 2.5%.
Whichever is highest.
Whichever is highest. And a really clear example was that big 10.1% increase back in April 2023. That was driven by the high inflation rate at the time.
Okay, so for people already retired on the state pension, the triple lock offers some protection against rising prices.
A degree of protection, yes. But what about those still working and saving into personal or workplace pensions? How does inflation affect them?
Yeah, the pot you're building up.
Right. For those pensions, which are typically invested in things like the stock market, the impact of inflation is a bit more indirect.
How so?
Well, inflation doesn't magically change the number you see in your pension pot statement.
Okay.
But it significantly affects its future purchasing power. What that money will actually buy you later.
Right. The real value again.
Exactly. If the investments in your pension don't grow at a rate that consistently outpaces inflation over the long term,
Hmm.
well, the amount you've saved might not buy as much in retirement as you hoped.
So £1 million might sound great, but if inflation has been high,
It might not actually afford you the lifestyle you were planning for. It's not just the nominal amount, it's what it's worth in real terms when you retire.
that makes perfect sense. It's crucial to think about the real value.
Totally. And that's why Pension B recommends that people consider increasing their pension contributions gradually over time, ideally in line with inflation if possible.
To keep the real value growing.
Exactly. It helps ensure your pension pot continues to grow in real terms, maintaining its future buying power.
Okay. And what about when you actually start taking money out in retirement?
Well, inflation continues to be a factor then, too. It will erode the value of your pension income over time.
So the income you get in year 1 of retirement buys less in year 10.
Potentially, yes.
Yeah.
Which is why it's really important to think carefully about things like annuities if you go down that route.
Annuities.
Yeah.
Guaranteed income for life.
Usually, yes. But you can get different types. An escalating annuity is designed to provide an income that increases over time, specifically aiming to keep pace with inflation,
Okay.
whereas a fixed annuity provides a set income. Which sounds simple, but that fixed amount will gradually lose its real value as prices rise year after year.
So the escalating one costs more upfront, presumably, but protects you later.
Generally, yes. It's a trade-off. So it's all about thinking long-term and understanding that the real value of your money is constantly being shaped by inflation, both while you're saving and when you're living off those savings.
Okay, lots to think about there. So to try and bring everything together, what's the main takeaway for our listeners from this deep dive?
I think the key message is that inflation, well, it's a persistent economic reality. It's always there, sort of nibbling away at the value of your money.
Right.
However, by taking the time to understand how it works and by actively implementing a combination of strategies across budgeting, saving, investing, you really can take meaningful steps.
You can fight back a bit.
You can fight back, you can protect your financial well-being, and mitigate those negative effects.
So it sounds like there's no single, quick fix, no magic bullet solution.
Definitely not.
It's more a combination of being financially aware, making informed choices about where your money is, how you spend it, and just staying informed about the bigger picture.
Precisely. And maybe a final thought for you, our listener, to perhaps mull over.
Okay.
Even a seemingly low and stable rate of inflation, say 2 or 3%, if it's sustained over many, many years, it can still have a surprisingly significant cumulative impact on reaching your long-term financial goals.
Yeah, that compounding effect works against you with inflation.
It does. So it's absolutely crucial to factor this ongoing reality into your financial planning and to really think about which of the strategies we've talked about today might be most relevant for you, for your own unique circumstances and your financial situation.